internet, but my stereo is hot.
What's going on, everyone? Welcome to today's third cumulative class. My name is Jerry B, and I'm honored to have you all here. Today, we're going to be building upon the key concepts that we spoke about on class 1, as well as class 2. And today, we'll be talking a bit about some real-time risk and liquidity concepts. So for class 1, we talked about candlesticks, and it just gave us a brief framework into what price action is. We then went on to speak about structure, talking about the breaks in structure. What does a change in character look like? What's the difference between the lower time frame as well as the higher time frame? And then we introduced some smart money concepts as well as retail. So talking about the premiums as well as the discounts and understanding how, if we are trading within the internal structure, we can take calls or puts to the upside or downside, or just wait for price to come to a point of interest, which will be an extreme 4-hour supply, daily supply, weekly supply, whatever the case is, or an extreme demand for a potential higher risk to reward. Now, these trades do take some time to set up. So it's good to be mindful of that when you're modeling your risk to reward, because if you are a swing trader, you might want to set your alerts at an extreme 4-hour supply, wait for price to kind of do its thing, and then wait for it to come back down to mitigate some fair value gap. And then we spoke about premiums and discounts as well for class 1. If we take our eye to the top right hand corner, we can see here that we introduced the price cycle. So the price cycle is Wyckoff's smart money or institutional way of communicating to retail traders that price moves in waves, right? Seeking to take out liquidity, seeking to take out stops, and to target some type of gap, some type of imbalance or inefficiency. If you look at the legend, you'll notice that the fair value gap or imbalance is going to be this blue circle right next to that stream of Moribozu candles. So I drew 3 Moribozu candles. The Moribozu candle in the top right-hand corner is a candlestick that leaves behind imbalances or inefficiencies after price taps into some extreme supply or extreme demand. It just indicates volume. Whenever we see price marking down from supply or marking up from demand, it's going to leave behind a fair value gap or inefficiency that price may later come back to target in order to follow the efficient market hypothesis. And that's what we're seeing here. Price comes into our supply zone or hypothetical supply zone at $100. We've got the first up move before an aggressive push to the downside. We can take this information and model around that fair value gap, right? Wait for price to come back to that extreme supply before looking to take it back to the downside to target the previous fair value gap that was left behind from the initial push back into supply. And we'll be talking about this in real time and modeling our risk to reward after we go over some key liquidity concepts. So for class 3, today's key objectives are going to be reviewing price cycles. We're going to talk a little bit more in depth about liquidity, what that looks like within the charts. We'll be doing some multi-time frame analysis and models in real time. And then I'll save some time for the end of the session to answer any questions that you all may have with regards to anything from classes 1, 2, or 3. So without further ado, let's talk about those price cycles. Okay. So understanding Wyckoff's price cycle. Wyckoff is a very difficult concept to grasp. You have UTAG, you have automatic rallies, you have all these different components and concepts that I don't necessarily think are significant to mark off in your individual chart. However, we can simplify Wyckoff into 4 key concepts. The market cycle, which is going to be composed of accumulation, which is our demand zone. We have our markup, which is our expansive move to the upside. We have our distribution, which is our supply zone, which is an area of consolidation, a period where the composite man or institutions are gathering orders from the upside or downside, considered, choppy price action. And then we have our final move, which is the markdown, where price puts in another lower low. So if we take a look at this example here, we can see that price action is consolidating within this area here. So this will be our accumulation phase. Price action marks up into some old supply area. We have our distribution zone, which is another period of consolidation before price marks back down into old demand. All right. And as mentioned earlier, we have a significant candlestick called the Moribozu or order block. Whenever price moves aggressively to the upside or the downside, it leaves behind inefficiencies, fair value gap. Sometimes you can see these gaps literally in the market, or you can use them, or you can see wicks that aren't touching within the Moribozu structure itself. But nonetheless, whenever price moves aggressively, it leaves behind inefficiencies or gaps that it will later come back into to fill in. All right. But our 4 steps here using Wyckoff's simplified market cycle are accumulation, which is going to be a period where the composite man is accumulating orders at some demand zone. We have our markup, which is where price breaks out of this consolidation period. Once price reaches its climax, we might experience a period of consolidation at supply before a mark back down into our old accumulation to put in a lower low if we're in a downtrend. And the reason price may put in that lower low is to fill in some inefficiency that was left behind. All right, we talked about this in depth in the last class. So if you missed the last class, I highly recommend you all check that out. But if not, we'll cover it now in this review. So accumulation is step 1. Whenever I see accumulation on the charts, I like to look for daily, 4-hour, or weekly spinning tops. Most of the times I'm trading on the 4-hour or the daily for my larger, higher time frame accumulation and distribution zones. Accumulation is another word for bullish consolidation, a period where bears and bulls are indecisive. We don't know if it's going to go up. We don't know if it's going to go down, right? But the only way we can kind of guess where price may go is based upon the higher time frame structure. If price is in a downtrend, we want to look for sells. If price is in an uptrend, we want to look for buys, right? Now, the reason for price action to go to the upside or downside is to take out liquidity. In order for the banks to move the market, they need stop losses. They need chart patterns. They need bull flags, they need symmetrical triangles, double tops, double bottoms, right? Fair value gaps. They need to tap into extreme supply zones or extreme demand zones where price was pushed aggressively to the upside or the downside in order to manipulate price and force it to do what it needs to do. All right. And we'll look at some examples on our 3rd key objective. But in this picture here, we can see that price is in our accumulation area. So whenever I'm marking this in the chart on real time, I'm looking for spinning tops on the 4-hour or the daily. So once I see price break structure to the upside, we're looking for a pullback into the 50% mitigation of that consolidation area, right? That's going to be that equilibrium point in the bottom left-hand screen. So let's pretend that this consolidation period is our 4-hour accumulation or supply. 4-hour accumulation or supply, I would have saw a spinning top and just marked off this entire zone here. All right. In order to confirm the expansive move to the upside, I personally will look for a Moribozu candlestick to indicate strength or breakout. Most retail traders recognize this as a breakout. So if you see that breakout, I'd like for price to expand back into the 50% of this zone before considering, taking the trade higher. Why is that? The reason for that is because whenever price breaks to the upside, it leaves behind inefficiencies, right? And I want to buy at a discount. I don't want to buy at a premium. I'm looking to buy for as cheap as possible and target previous liquidity, which is going to be double tops, double bottoms, equal highs, equal lows, things of that nature. So phase 2 for Wyckoff's price cycle is going to be our expansive move to the upside, or the markup. The expansive move occurs when price breaks out of a period of consolidation while leaving behind some imbalance, order block, or supply and demand zone due to inefficient price action. The best way to discern this or just see it visually in the chart is to look for those long Moribozu candlesticks that have little to no upper wick. These candles are neutral candles, and they leave behind inefficiencies that we can later target to model a more discounted risk to reward whenever we're trading price action. So in this example, we will be looking for buys into an old supply zone. So we have this period of consolidation. You can recognize this as spinning tops or some indecisive candle. You might mark up a extreme doji at supply. But once you find that supply zone, you're looking for your fair value gap, looking to see where inefficient orders were left behind that we can later target for calls into supply, or just wait for price to come into our supply zone, fill in that fair value gap, and then take it back short to the downside. Which leads me into the next key topic, which is our break-in structure. So here we have a period of consolidation, right? Institutions are buying and selling orders, prices trading inside of a range. You might hear traders use inside day range, 4-day inside range, or whatnot. That's just a period where price is just bouncing back and forth off of its key support and resistance areas. All right. Once price sweeps liquidity, which is going to be these lows here, that is going to be a break in structure. When price breaks structure, 9 times out of 10, we're going to see some long red body candlesticks if we're trading to the downside. This is going to indicate volume is moving, downwards, right? So this is going to be a break in structure. That's the abbreviation, BOWS. Now what we can do is wait for price to tap into some old demand zone from the past, or key support, key dark pool area, or whatnot. For the sake of simplicity, I'm going to call this 4-hour demand. Now, we know that price is going down. So if price taps into our 4-hour demand, we want to look for a Moribozu candlestick, buyers to indicate strength or an intention of pushing price back up into our old fair value gap to fill in that gap. So if I were to take this trade long, hypothetically, I want to see that breaking structure first, pull back into the 50% of our demand zone, and then a liquidity sweep of the previous high to target this imbalance. You see, everything within Wyckoff's theory is based upon cause and effect. There's a reason for everything. The reason that price would come back up into the supply is to fill in this imbalance. It will be to fill in an imbalance. Okay. So now we have our reversal or change in character. The reversal is going to occur whenever price is moving in the opposite direction within the internal structure. So in the previous example, if we were to trade within the opposite direction after we had the initial break in structure out of this consolidation phase to target the fair value gap at the most extreme supply, we want to see a change in character. Okay, so a change in character is going to occur whenever price is moving in the opposite direction within the internal structure. In order for price to move within the internal structure, there needs to be equal highs, equal lows, or an unmitigated zone within the internal structure. And if we take our eyes to the right, we can see some examples of what that might look like within the charts. So as we can see here, we have different forms of liquidity. In these examples, we have our trendline liquidity, and double top liquidity. Based upon my experience, I found that the best zones to model risk to reward off of are ones that put in a new significant lower low, as well as take out liquidity. So in this case, price put in a significant lower low, breaking structure, and it took out this previous low, previous liquidity here, all right? While also leaving behind equal highs or equal lows. So in this case, this zone is unmitigated. It hasn't been tapped into yet. So the safest risk to reward would be to wait, identify the liquidity within the internal structure, and then model your risk to reward. So in this case, we have two zones. We have zone A, and we have zone B. It wouldn't make sense to target zone A because there's still resting liquidity up here that institutions may be targeting based upon the previously left behind fair value gap. So whenever price moves down aggressively, there's imbalances that are left behind. So we want to be able to identify the initial break in structure, which is this significant low here. We want to identify our liquidity, which are going to be these equal highs, and the most extreme supply zone before looking for sells to the downside. And it's the exact same thing for buys. Let's call this 4-hour demand. price breaks aggressively to the upside, leaves behind some imbalance that's close to our demand zone. The next time I want to look for buys is after price sweeps the liquidity before filling in this imbalance to target the previous swing high to put in another higher high. So first things first, looking for a significant break in structure. Identify your fair value gap or inefficiency. You could, wait for price to take out these highs and take shorts back to the downside. Or just wait for price to return to your point of interest. So the cause here is a break in structure to the upside. The trend is bullish. We're following the order flow. The effect in order to keep price going in this direction is to target engineered liquidity, fill in some fair value gap that was left behind. Once price comes back into our point of interest at our most extreme demand zone, that's when I would look to take it long to target previously left behind imbalance caused by this move to target this liquidity, right? So once these highs got taken out, these lows need to get taken out to fill in this fair value gap in order to put in another higher high. All right. Now let's talk a bit about liquidity and what they may look like. So you have multiple types. You have your equal lows, which are the easiest to identify. Sometimes you might have slanted lows. Also recognized as trendline liquidity. You also have a range of lows with liquidity resting above and below. In this case, this would be recognized as a rally-based rally. If you're a supply and demand trader, this might be something that you might see happen in the charts over and over again. Price gives us an expansive move markup to the upside, a period of consolidation, and then another markup to put in another higher high. So this is going to be our range liquidity. You also have equal highs. Slanted highs. Drop, base, drop, which is another example of range liquidity. And then, of course, your infamous trendline liquidity, which is, your break-in trend. All right, let's take a look at an example of target. So this was a trade that I took yesterday. I didn't take any longs. I took this trade short. So if we go to I believe I modeled this on the 1 hour. Yeah, I modeled this trade on the 1 hour. So if we go to the 1 hour time frame, In the first class, we spoke about upper wicks and lower wicks. So the upper wick is going to indicate a period of distribution, right? So this was the most recent upper wick here for supply. Most recent demand zone here, Moribozu order block for demand. These were my supply and demand zones when I initially marked up this trade. Now, if we go to the 15-minute time frame, what I was looking for is for price to tap into that 1 hour supply, show me a change in character, and a break in structure. So price taps into this 1 hour supply. It shows us our spinning top, which is going to be a range of indecision. So what we could do is mark off this entire range here. So price swept liquidity to take out these highs and then gave us a significant break in structure towards the downside. It's not necessarily a Moribozu here, but we can see that this candlestick is long and red, indicating downwards momentum. Okay. So this is going to be our break in structure for phase one. Phase B in Wyckoff. Next up, I'm looking for price to give me equal highs or equal lows, tap back into the 50% mitigation of my spinning top, which tells me where buyers and sellers are at equilibrium. They're at a standstill. So we have these equal highs here. Once that gets swept, that's when the previous wick becomes the stop, or you could, mark up the high of the spinning top as your stop. And then what we're doing is targeting some imbalance within the internal structure. So for this particular trade, I was targeting these equal lows down here, as well as this imbalance fair value gap that was left behind due to the initial push to the upside. Mind you, the trend is bearish because of this aggressive gap down, right? So this gap down tells me that sellers are very strong with pushing price to the downside. So within the internal structure on the lower time frame, I'm looking for price to come to my point of interest, 1 hour supply. I'm looking for equilibrium, doji, spinning top, et cetera, et cetera. I'm looking for price to sweep to the downside, indicating momentum is pushing down, and then return back to the most extreme supply zone that hasn't been tapped into yet. So that's going to be the upper wick of the spinning top after it comes back into that point of interest. And the reason for price going back down is to target these equal lows or to fill in this imbalance. Since I wasn't interested in swing trading, I decided to take this scalp on the 5-minute time frame to target this imbalance here to the downside. But if I would have swung, it would have gone all the way back down to that 1 hour demand zone. Let's back test another example. Let's take a look at SPY. All right, so SPY, there was a scalp that I caught by the end of today. Let's go to the 1 hour. Actually, let's do a clear chart and remove these indicators. All right, so on the 1 hour, we can see here that the session open was here at 390.5. Price put in a high of 395 here. So intraday, I was looking for my key areas of supply and demand, which was a swing high and swing low on the 1 hour. On the 1 hour, I noticed that there was a spinning top here, indicating a possible reversal or indecision. SPY is clearly in a downtrend, so I was looking for shorts. So I noticed, excuse me. So intraday, I noticed that price was trading within this range all day. Price was trading within this range all week, not all day, pardon me. Up and down, up and down, up and down, up and down, up and down. And then finally, boom, we got a break in structure towards the downside. That's Bose. So on the 1 hour, I marked off my swing low, my session high, and I noticed the spinning top, which indicates indecision. Let's drop down to the 15-minute time frame. H1 spinning top. So for supply and demand, on the 15-minute, we're looking for the first red candle before an aggressive up move or push to the upside. So this is the first red candle before our push to the upside. Mind you, on the 1 hour, we already saw our spinning top retesting structure. I noticed this at around 1 o'clock. So what we can do is mark up this entire spinning top here and refine it as we go down to the lower time frame. 15-minute. Now that we're on the 15-minute time frame, I'm looking for a break in structure. Once price broke structure to the downside here, that gives me step one for my confirmation. Now to take this trade, I'm finding the most extreme supply zone on the 15th. So that's going to be the first green candle before our push to the downside. So I waited for price to come back to my point of interest before considering taking the trade lower. But in this scenario, price did not return to my point of interest when I wanted it to. So I took the trade for a quick scalp off of the previous demand zone. So we have two scenarios here. We can look for a break and retest here, targeting these equal lows, liquidity, to fill in the imbalance that was left behind from this Moribozu. Or wait for price to come back to the most extreme supply zone before modeling our risk to reward to the downside. But in this case, I took this for a quick scalp off of the most recent supply zone here. Right? So this was a quick scalp, 1 to 3 for me. But in this case, as we can see here, price action taps in to this inefficiency, fills in the gap left behind from this Moribozu to return back to the most extreme supply zone. Does that make sense? So the cause and effect here is step one, you want to look for price to come to your point of interest, right? Our point of interest is the 1 hour spinning top. Price broke structure to the downside, and I'm targeting the imbalance that was left behind at our 1 hour demand zone from the session open. So the reason for price coming down is to tap in, sweep these stop losses down here to fill in this imbalance before coming back up to the most extreme supply zone or the 200 moving average. Let's see how this plays out. So my RR on this trade here was a 1 to 3. The cause was a change in character, break in structure, and the reason was to fill in the imbalance left behind from this Moribozu. Price action tapped into this imbalance to take out these highs. Now, if we hold 394, 395, we could ride it up to 400 easy. But if price action decides to fill in the imbalance that was left behind on this move up, then we could ride that momentum back down to target these lows, because now price has a reason to return back down here. All right, because we have our initial break in structure for step one. Price comes back up into some unmitigated area, taps into this wick here, or fills in this gap, and now it looks to be showing weakness before the next swing low. But if price action gives us a break in structure to the upside, then the order flow will continue to be bullish. But if we look at the 1 hour, we can see here that price is breaking through our period of consolidation, came back up to retest, and now looks to be targeting a left behind imbalance on the 1 hour. Would be the same as a retest. Yes, exactly. That's pretty much all you're doing. You're just trading fancy retests of structure, and you're looking for liquidity within the most extreme supply and demand zones. All right, let's take a look at another example. I took PLTR for a swing yesterday. Actually, no, I took it for a scalp today. I was gonna swing, but I was chicken. All right, Palantir. right, so for Palantir, I'm going to just use the daily, 1 hour, and the 15-minute time frame. So on the daily, the first thing I noticed was this big Moribozu candlestick here. The first thing I noticed was this big Moribozu candle, right? The first down move before that aggressive up move is going to be the body of this candlestick here. Daily supply, spinning top. Daily demand, spinning top. We can refine these zones to make them a little bit cleaner. So I see that there's a gap within structure here, and there's a red candle before price gapped up and then, pushed into this doji here. So let's call this daily demand, daily supply. When I look to the left, I can see that price action has swept all of these stops here and broken structure to the downside. On the higher time frame, we currently have a bearish bias because of this big Moribozu sweep towards the downside. Price breaks towards the downside, comes all the way back up to try and fill in some inefficiency that was left behind, right? And now we're seeing weakness here, indecision from this supply zone. So this tells me that price is getting ready to put in another lower low to continue the trend to the downside. Now let's take a look at the 1 hour time frame. On the 1 hour, we're looking for the most recent swing high and swing low. Some imbalance as well as liquidity between the imbalance and our supply and demand zones. Swing high. We've got a hammer here. Most extreme swing low. Remember on the daily, we marked off this range because it was the body of this first down move before this Moribozu push to the upside. We know whenever we see these big green candles or big red candles, they leave behind inefficiencies and imbalances. So if we go to the 1 hour, we can refine our zone a bit more to see that inefficiency and use it as a means of modeling our risk. So what I'm doing here is adjusting my zone to the first red candle before this Moribozu push to the upside. Okay. In this example, we can see here that there is resting liquidity underneath our daily supply, as well as an imbalance that was left behind from the previous push higher. So from a bird's eye view, the reason for this trade to continue lower is to sweep this liquidity, retest structure, fill in this imbalance. Let's drop down to the 15-minute. So price is currently testing that resistance. I didn't get my alerts until it hit the 200 moving average, which is my purple MA here. So once price tapped into that $8 moving average, I looked to the left and I said, okay, where is the most recent 15-minute demand zone? When we look to the left, we see the institutions pushing price aggressively to the upside. Retail traders can't move the market this fast, right? So this here tells us that this zone is valid for identifying a liquidity pool to push prices higher, which makes sense because there's equal lows underneath our daily supply zone. So all we're looking for now, well, all I was looking for was a break in structure, a retest of the 50% mark of this 15-minute zone, and then a follow through to take out the previous swing low and to fill in this imbalance. So the risk in this trade here is going to be the 200 moving average, which is $8. Our target is going to be our 1 hour demand to fill in some inefficiency and to follow the order flow. Stop loss goes above the supply zone. So price action gives us a break in our structure, fills in this imbalance. This time, price comes back up once again. After showing strength, we have our Moribozu candlestick here. Price taps into our 50% mitigation of this Moribozu candlestick and is now getting ready to put in another lower low to target these stop losses and to now fill in this imbalance. So for tomorrow, I'll be looking at Palantir puts at the bell. And the reason is to target these lows, to continue to follow this trend, and to fill in this imbalance that was left behind after institutions move prices higher. So the risk to reward on this trade will be as such. I'm going to go to the 1 hour time frame. Start off with a clear chart. Identify the liquidity. We have equal lows here. We have our imbalance. And we have our first red candle before the aggressive up move. 1 hour demand. All right, let's find our 1 hour supply. This up move caused price to come all the way up to the 200 moving average. So this first down move, this first green candle before our up move is our supply zone. And then when I look to the left, I can use price action as confluence. I see a bearish Moribozu order block that has already been mitigated. Mitigated means touched or tapped into. So price gave the initial break, retest, and we have another break in structure towards the downside. Whenever I'm looking for breaks in structures, I like to confirm with a candlestick close under old demand or old supply. So in this case, price action closed under this old supply zone. Let's take a look at the 15-minute time frame. I'm going to call this M15S so I don't get confused when taking these at the bell. The cause is going to be our break in structure, which is this move here. The effect is going to be to target these equal lows as well as the imbalance left behind at our daily demand. Price target is going to be the double bottom for PT1. PT2 is going to be the start of the imbalance. So 7.25. Then PT3 is going to be the 50% mitigation of this imbalance. So 7.15. Stop loss goes above supply. So 7.7. And I'm just looking for a good reaction, looking for price to break through our 15-minute supply, come back up to retest, and then I'll take it with small size, and then size up upon the momentum. If price does go long, I'll look for longs over 7.8. And the reason for longs would be to target these gaps that was left behind. But I'm not really interested in longs. So if price does invalidate structure, then I'll just look for another stock to trade. But if price gives us that break and retest, of 7.6 key level, I'll look to take shorts back down to 7.15. But let's go ahead and prepare for the upside just in case. PT1 for longs is going to be the 200 MA. And then the imbalance that's above it. So I'll have my alert set at 7.8, 7.6, 7.55. And we're just looking for a bearish reaction for continuation. All right. So just a quick recap. For today's session, we talked about price cycles. We went over liquidity. We did some multi-time frame analysis for target, a few trades for SPY as well as Palantir, and set up something for ODTE for tomorrow. So if you all have any questions with regards to what we spoke about today, class number 202 or 101, feel free to type in the chat and let me know. When you find your price targets, is that the strike price at which you buy the option? No. Whenever I'm buying my options, I always go at the money or in the money. My price targets are based upon the effect of what I think price is going to do. So in this case, my price targets are to target this double bottom liquidity as well as the imbalance. So if I wanted to go in the money, it would make sense for me to, target 7.5 strike or $8 strike. Let's say the $8 strike is like $15 or $20. I will automatically be in the money as soon as price breaks under 7.8, 7.7. So I like to calculate when I will be in the money after hitting one of these, reasons for price to return back down to the downside or upside. So in this case, it's to target this double bottom as well as filling this imbalance. So 7.5 will put me in the money somewhere between 7.38 and 7.25. Does that answer your question, Mr. V World? Of course, my pleasure. Was today's class helpful for everyone? Did you all learn something new or get any new concepts? Hopefully I broke everything down in simple terms. I mean, it can, but it's really risky. It's risky when you're going out of the money because you have IV and all types of other Greeks and components that could impact your contract. I think it's safer to protect your capital by just going at the money. That way you'll at least get 20, 30% or can cut at -10 or 15. Do fair value gaps always get retested? No, fair value gaps do not. Sometimes you might get stuck inside of CHOP or sideways price action. So that's why it's good to wait for price to come to you. So whenever you see price come to you, you're essentially trading a liquidity sweep. So you're not just entering at random. So once you see price sweep up into some demand zone, you're looking to ask yourself, okay, where's price going? Is price continuing up into some old fair value gap, or to tap into some unmitigated supply? Or are institutions inducing buyers so that they can put in another lower low? So these are the questions that you kind of have to ask yourself to know which fair value gaps to target. Of course, my pleasure. Can you explain the volume and open interest? Of course. Oh no, my Apple Pen died. No more whiteboard time. Sorry, my Apple Pen died. But volume essentially is going to be the amount of shares being traded within the option contract. Open interest are the amount of contracts that are being held. So let's say you're looking to trade a breakout, right? Correct me if I'm wrong. Correct me if I'm wrong, but this is how I look at it. Whenever I'm looking for volume on ODT contracts or, good contracts, I want to see the volume exceed the open interest. I want to see buyers interested in buying the actual contract 3 times the amount of the contracts that are being held. This in itself tells me that there's a lot of buy side interest or sell side interest, depending on where price goes, because you could see volume 3 times the open interest on calls for, let's say, 395 calls. And then you might see the same thing for 390 puts. But you need to understand, okay, why is price going to go above 395 and why is price going to go below 390? Is there some fair value gap above or below? Is the trend bearish? Is the trend bullish? Is there going to be some type of news coming out? Are buyers being induced to push price above 395 into supply before bringing it back down past 390 to 389, right? So those are some questions that, you can ask yourself, because either side could make money. But nonetheless, your volume is just going to be the amount of shares being traded within a given time period. Open interest is the amount that are being held. Being held as in they haven't been sold yet. Does that answer your question, Mr. Sanders or Ms. Sanders? What are your top 5 indicators? Me, myself, and I. No, I'm just kidding. My top 5 indicators. So I like the 200 moving average, the 50 moving average. I don't really use this volume indicator anymore because it's random. But 50 MA, 200 EMA, and this institutional fair value gap liquidity range indicator has been pretty promising when I don't feel like identifying fair value gaps within the price action. It'll kind of just tell you where the gaps are itself. So that's a good one. Yeah. So top 3, actually top 4, RSI, 50 moving average, 200 moving average, and the fair value gap and liquidity range indicator. So as we can see here, I identified this fair value gap. Just looking at price action itself, and we have an extra confluence. Once I pulled up the indicator, it tells me this is indeed a gap that could get targeted for this play to the downside. Of course, my pleasure. Honestly, for me, this is what teaching day trading really is. It is difficult learning as price is moving. We have to understand what the candles are telling us. If we learn based on history, that doesn't help. So thank you. Yes, price action is random. No trade will ever be the same. I believe everyone should learn structure and understand why price is going where it's going, why price is doing what it's doing, and then model your risk based upon that. Like you could literally have a 50% win rate, but if you know why price is doing what it's doing, you could still know when to size up, when not to size up, when to sit on cash, things of that nature. And it just comes with practice, right? So don't give up. Pace yourself, trade with very, very small capital, and study yourself, right? Once you learn yourself and learn structure, it'll kind of come to you over time. This isn't easy, but I applaud you all for sure for just taking the leap and learning. If more people are interested, then volume isn't that volatility. I'm not sure I understand your question. The volume is the amount of contracts. The open interest is the amount of people interested. I like more volume than open interest. Likewise. Actually, I do understand your question. Yeah, if more people are interested in volume, isn't that volatility? Yeah, that is. All right, I've got enough time for maybe one more question. If you all have any questions with regards to liquidity, supply and demand, concepts, my favorite color, et cetera, feel free to let me know. If not, I will go ahead and conclude the session. Of course, my pleasure. All right, thank you all for your undivided attention as well as your questions. It's very enlightening to see that you all are engaging throughout this lesson. But yeah, I hope y'all have a wonderful class, and I'll see you all tomorrow. I might call out a couple of plays. Who knows? Take care, everyone.